Good afternoon, and thank you for standing by. Welcome to the AFS Best Practices Leadership Council webinar. Our topic today is Pricing Fundamentals, a review of the third quarter commercial lending landscape. This webinar will be approximately an hour long, and our speakers today are Don Doherty, Jeremy Charlson, and Rob Lynch from AFS Business Intelligence. Before we get started, there are a few housekeeping items. We are recording today's session, and therefore all lines have been muted. We do encourage questions. You can use the Q&A feature to ask questions. We'll leave some time at the end of the presentation to answer questions. Tomorrow, you will receive an email with a link to listen or download the presentation. Thank you for joining us today. Don?
Thank you, Renee. Hello, everyone, and welcome to our webinar, a review of the third quarter commercial lending landscape. We here at AFS hope you, your families, and your coworkers are doing well in these very challenging times. As we get started, I want to say that we certainly welcome any comments any of you may have on today's webinar. Our contact information is provided at the end of this presentation, so please do not hesitate to reach out to us. We will be glad to help you. It is worth noting that the source of the data presented today is from the AFS Pricing Service. This database is the industry source of pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. This database is also used to prepare our monthly Pricing Trends newsletter. Again, please reach out to us if you are interested in learning more about our pricing service or if you are interested in receiving our monthly newsletter. As we move to slide 4, today we will be reviewing results through the third quarter with a focus on loan growth, followed by Rob Lynch looking at pricing and fees. And to round out today's webcast, Jeremy Charlson will provide valuable insights on risk and return. And it should be noted that our charts, unless noted otherwise, will exclude or do exclude the PPP loans. So to get started, we move to slide 5 and provide some context for the business and economic environment that banks are operating in currently. The U.S. economy contracted in 2Q with a GDP of minus 31.4%, representing the largest decline on record. During the third quarter, state governments gradually eased restrictions designed to curb the spread of the pandemic. Business activity resumed, and there was a resurgence in consumer spending, which resulted in the largest single quarter of economic growth on record, and was roughly twice the prior record set in the first quarter of 1950. It is worth noting that mathematically, a 33.1% increase does not mean that we have recovered all of the lost ground from the prior quarter. So, with plans for another round of fiscal stimulus still uncertain, it is anyone's guess how long and how consistent this rebound in economic activity will be. Moving to the top right, we have the national unemployment rate. Unemployment continues to fall, but remains far above the low levels we enjoyed prior to the pandemic. Historically, the unemployment rate correlated very strongly with commercial loan defaults. That relationship has broken down somewhat in recent months, as loan deferral programs have provided many borrowers with a critical lifeline and muffled the impact of the pandemic, at least for now. The bottom left chart shows the 10-year Treasury yield, which in September was trending close to the all-time historical low point. We see this trend reflected in rates charged on commercial loans, which remained well beneath the level seen a year ago. In terms of commercial loan pricing, we are seeing spreads widen, especially for the riskier deals. Finally, on the bottom right, we plot the Industrial Production Index, which is analogous to a GDP-type measure for the manufacturing sector. Much like the trend in real GDP, industrial production plummeted in 2Q and then rebounded in 3Q. Manufacturing remains one of the largest industry exposures for commercial loans, so trends in this metric help reveal the direction of both commercial loan growth and credit quality. On balance, these indicators paint an improved but still uncertain picture for commercial lending. And more than ever, banks will have to be certain that they are pricing adequately for the credit risk in their portfolios. Moving to slide 6, we thought it would be helpful to relate the loan trends we are seeing to the outlooks that banks have shared about their loan portfolios. Our team here at AFS compiled these highlights from the bank's Q3 earnings releases. A few themes and concerns were shared among the banks. First, by almost any capital and earnings measure, 3Q was a better quarter for the banking industry than 2Q, knowing that 2Q set the bar very low. And significant headwinds for loan growth persist, the most pressing being the risk that government fails to deliver another round of stimulus. Next, banks are also reporting a, quote, normalization in line utilization when compared to the high rate seen in March and April. And we'll see more on this topic a little bit later. And finally, credit quality is taking center stage, with the general expectation that charge-offs will increase and peak sometime in 2021. Complicating matters is that many loan deferrals are expiring soon, and banks anticipate a far fewer number of commercial borrowers receiving a second deferral. As we move into the loan growth section of today's webcast on slide 8, we continue to see the scars that the pandemic has left on the economy and commercial lending. Comparable to the severe swings we saw in the real GDP trend, total C&I loan growth has fluctuated by deviations the likes of which we have not seen in modern history. Total C&I loan balances declined throughout the third quarter, falling at an annualized month-over-month rate of minus 23.8% in September. This decrease appears somewhat small in this chart relative to the large swings seen earlier in the year. However, it is worth noting that we are not that far away from the largest month-over-month decline recorded during the Great Recession, which was a negative 33.7% in July of 2009. A number of factors are weighing on commercial loan growth. Payments have accelerated in recent months as many larger end borrowers that drew defensively on lines of credit in March have since paid back their loans. Several banks are shedding their highest risk loans, while investment grade companies are increasingly turning to capital markets rather than pursuing bank credit. Today, we will shed light on how this downturn is playing out across the market segments. Moving to slide 9, we look at the quarter-over-quarter loan growth for the third quarter. Looking back over the year, there was unprecedented growth at the end of the first quarter. In 2Q, the quarter-over-quarter loan growth rate for all loan types plummeted to a negative 5.26%, and now for 3Q, although still negative, there was an improvement over 2Q with a quarter-over-quarter loan growth rate of minus 3.27%. We saw higher payments in 3Q offsetting tepid volume in new originations. The chart on the right shows only CRE bilateral loan balances in 3Q20 were higher quarter over quarter, with a modest increase of just 0.19%. C&I bilateral loans were down 1.76% due to lower balances in the wholesale trade sector and in the manufacturing sector focused on wood and chemical products. These two sectors, along with the manufacturing sector targeting machinery and electronic products, also contributed to participation balances dropping sharply in 3Q, down almost 8%. Next, on slide 10, we changed our focus and look at year-over-year loan growth. Although balances fell dramatically during the third quarter, total balances are still higher than last September, up roughly 1%. The chart on the right shows that higher CRE bilateral loan balances, up 6% year over year, were in part responsible for this 1% increase. Participations were also higher, up about 1%, while C&I bilateral loans were down 2.42%. We saw lower C&I bilateral balances in the wholesale trade and retail trade sectors, contributing to this year-over-year contraction. On slide 11, we now look at the loan growth that occurred during 2020. Here, the loan size ranges segment year-to-date loan growth. For all loan types, the chart on the top left, we see loans have decreased year-to-date for each of the loan size ranges less than $25 million in size, while the largest loan size range, greater than or equal to $25 million, posted a 5% increase. Similar results are seen for C&I bilateral loans, the top right chart, and C&I participations, the bottom right chart. The bright spot this year is CRE bilateral loans and CRE participations. The bottom left chart shows negative growth for only the smallest loan size range for CRE bilateral loans, while CRE participations are up 6.25%. As we move to slide 12, we present a quadrant view showing differences in loan growth by state. The top left chart focuses on year-to-date growth for all loan types and presents the top 5 and bottom 5 states. Here we notice that each of the top 5 states saw significantly higher balances in the real estate sector, specifically in the lessors or real estate subsector. Conversely, in the bottom 5 states, Ohio, Illinois, and North Carolina, each reported lower balances in the motor vehicle and parts dealers subsector within retail trade. This is not surprising given how many people continue to work from home due to the pandemic and therefore not driving their cars as much as they once did. California is the only state to appear in the top 5 for every loan type. In addition to higher CRE balances, California also saw higher C&I bilateral balances in the finance and insurance sector and higher participation balances in both the utility sector involving electric power generation, transmission, and distribution, and in the information sector's publishing industries, except internet subsector. Moving to slide 13, one of the leading indicators for commercial loan growth is real GDP. For the last several years, the 10 largest CBSAs in terms of real GDP significantly outpaced the rest of the country for commercial loan growth. In other words, cities with the highest levels of economic activity and growth tended to generate the highest levels of commercial loan growth. We presented this slide in our last webinar using a December 2018 baseline to measure growth in outstandings. For today's presentation, we moved the baseline up to 2019 to present the year-to-date results. For the markets outside of the top 10 CBSAs, the declines in 3Q more than erased the gains from earlier this year. It will be interesting to see if the markets outside of the top 10 CBSAs are able to reverse course during the fourth quarter and move into positive territory, closer to the growth rate of the top 10 CBSAs. We know that our pricing service has the data to help you find where loan growth is occurring and can help you pinpoint where opportunities exist in today's ever-changing markets. This is something that we will continue to watch and report in our upcoming webcasts. As we move to slide 14, we often see a strong correlation between loan growth and particular industry sectors. Here on the top chart, the arts, entertainment, and recreation sector led total balance growth for the first 9 months of the year. One reason year-to-date balances are higher can be attributed to continued higher line of credit utilization rates for this sector during the third quarter. September's rate of 43% is still up 7% from December. Los Angeles, New York, and Atlanta all reported higher year-to-date balances in this sector. And it is also worth noting that San Francisco saw balances decrease by 23% in the same sector. The finance and insurance sector ranked highest for year-to-date C&I bilateral loan growth, as shown by the chart on the bottom left. Over the first 9 months of the year, balances remain high in this sector in Los Angeles, Birmingham, Alabama, and Miami. For participations on the bottom right, we see the arts, entertainment, and recreation sector led participation balance growth. Again, Los Angeles and New York contributed to these higher balances, as well as Louisville, Kentucky. On the next two slides, we will look at some of the factors that have a direct correlation on balance growth. That is line of credit utilization and new and renewed loan volumes. Slide 15 looks at line of credit utilization rates. During the first quarter of the year, the growth in total balances during March was fueled by an increase in line utilization. Now, 6 months later, line utilization rates for almost all of the industry sectors are lower than they were at the beginning of 2020, which certainly contributes to the lower loan balances we are seeing. However, looking to the far right on this chart, two sectors continuing to display elevated line utilization rates are arts, entertainment, and recreation, which I just mentioned on the preceding slide, and accommodation and food services. While utilization is down from the prior quarter for both sectors, rates remain above the level seen prior to the pandemic. Higher line utilization is one proxy for credit distress, as borrowers tend to tap lines of credit when they have an urgent need for cash. These two sectors have been hit especially hard by the restrictions designed to curtail the spread of the COVID-19 virus, so it is not surprising that the line of utilization remains elevated for these two industries. On the next slide, another factor contributing to overall loan growth is the impact of new and renewed balances. We can see new volume ticked up in September from last month, but when compared to September of last year, overall originations are down 21%. New C&I bilateral loans were up a little less than 1% year over year, while CRE bilateral loans and participations were both significantly lower than last September, down 28% and 36% respectively. Renewal volume was slightly higher in September compared to last month, and renewals are 2% higher than the level seen in September of last year. A 12% year-over-year increase for C&I bilateral loans offset decreases of 9% for CRE bilateral loans and 12% for participations. In aggregate, year-over-year, new and renewed loan balances are down 13%. And now I will turn it over to Rob Lynch for the pricing and fees segment of our webinar today. Rob?
Thank you, Don. Good afternoon, everyone. In looking at pricing for new and renewed loans, we can see that not much has changed in the third quarter. The chart in the upper right shows that interest rates for new and renewed C&I bilateral loans decreased slightly, while participations, shown in the lower right chart, increased slightly in the third quarter. All interest rates are in a tight range, with CRE bilateral loans shown in the lower left chart having the highest rates and C&I bilateral loans having the lowest. On the next chart, we look at C&I bilateral LIBOR and prime-based loans by term. Next page there. For the third quarter, rates are higher for the longer terms, and this is noted by the blue bars. The spread on those loans, noted by the orange bars, increases sharply when the term is greater than 1 year, but does not get much higher for those loans with terms greater than 5 years. Next, let's take a look at this same group of loans by industry. On this chart, the blue bars again are representing the interest rates, and the orange bars are representing spread. Across all industry breakouts, interest rate distribution for the third quarter is within a 67 basis point band, from a low of 208 basis points in healthcare and retail and wholesale trade to a high of 275 basis points in mining and transportation. Spreads are similarly aligned, with a distribution of 61 basis points, the low of 132 basis points in finance and management, and the high of 193 basis points being in mining and transportation. With interest rates overall staying steady this quarter, we turn to the use of interest rate floors. Next chart. In the left-hand chart, we can see a leveling off of the use of floors for both LIBOR and prime-based loans. LIBOR loans have hovered just below 25%, while prime-based loans are consistently above 50%. The impact of these floors is shown on the chart on the right, where of the loans that have a floor, roughly 60% of those loans for both LIBOR and prime are priced at the floor. The floor rates, as depicted by the red and the green lines, have been remarkably steady over the last 6 months, with September beginning to show some signs of decline for the LIBOR floor rate. Next, we'll look at fees, which are also a source of income for the banks. And on this next slide, we can see that fee incidence in the upper left-hand chart increased for new loans and decreased for renewals. Fee level in the upper right-hand chart has increased for both new and renewed loans over the last few months. Comparing September 2020 to September 2019, fee incidence on renewals was below the level seen a year ago, while fee incidence on new loans was higher. Fee levels were above those seen a year ago for both new and renewed loans. When looking at fees by industry, we can see that fee incidence in the lower left-hand chart is consistent with those seen a year ago, while fee level in the lower right-hand chart showed a large increase for mining and transportation, while healthcare showed the largest decline. With that, I'm going to turn the presentation over to Jeremy Charleston, who will discuss risk and return dynamics. Jeremy?
All right, thanks so much, Rob. And Renee, just real quick, I got a message on the webcam saying that my audio was kind of coming in and out. Can you just confirm you can hear me?
Yep, we can hear you great, Jeremy.
Perfect. All right, thanks so much. And thanks, Rob, for the summary on pricing. A lot of interesting dynamics going on in the market. So for this last section, we'd like to layer in the credit risk aspect or dimension along with the pricing to really analyze what's going on in the commercial space in terms of risk and return. Now, analyzing risk and return has always been a focus of these presentations, but more so than ever, we really need to consider how credit quality is influencing and shaping the pricing trends. So the slide that we have here, this is a risk composition of commercial loans, both C&I and CRE combined. And here we divided the population into investment grade loans, which is the blue series, and non-investment grade loans, which is the orange series. So investment grade loans are those with a credit rating higher than and including BBB. And since not all the banks that we work with use a bond equivalent rating scale, behind the scenes what we did is we aligned the unique risk rating systems of all the banks to the RMA obligor risk rating scale. So this allowed us to apply the investment grade versus non-investment grade categorization to all the banks so that we can more easily compare loans across different institutions, different industries, and so on. So the left-hand chart here is just focused on the new originations and the split between investment grade and non-investment grade for the new portfolio. In 3Q20, approximately 2/3 of the total new volume was risk graded as non-investment grade, which is a much higher ratio than we saw in the preceding quarter. That actually caught me by surprise. I had expected that with the general tightening that we're seeing in this environment, that non-investment grade loans would actually have more trouble obtaining credit and would be a smaller portion of the total volume. But I think two things are happening here. First, perhaps banks are being more conservative in their risk appraisal than they were even a quarter ago. So what do I mean by that? Let's say that there was a borrower that would have been risk rated investment grade a quarter ago. Now banks, because they're being a little more conservative, that same borrower is being risk rated non-investment grade if it were applying for a loan in the third quarter. So I think the fact that banks are getting more conservative could account for why we're seeing non-investment grade loans represent a bigger portion of the total. The second factor is that with all the Fed's moves to unfreeze and backstop bond markets, that's really set off a large-scale issuance of high-grade corporate debt. And many of these higher-end companies are using bond proceeds to pay down bank lines. So Don had that chart earlier where we saw utilization was coming down. He mentioned that payments were accelerating. A big reason for that is these higher-end borrowers, they're borrowing in the capital markets and using those proceeds to pay down the commercial loans. So the net result is that for banks, there's a population of fewer investment grade borrowers to lend to, and that's why the orange series, the non-investment grade portion, is growing over time. Non-investment grade loans also make up a similar percentage of the renewal volume, which we can see on the right-hand chart. Year over year, the percentage of renewals risk-graded non-investment grade increased, which could, among other things, reflect risk rating downgrades for existing borrowers in high-risk industries. So we're hearing from banks that industries like hotels, oil and gas are starting to see rating downgrades over time. We'll have a picture of that in just a few slides, but we do think that some of the increase in non-investment grade volume for renewals could indeed be because of risk migration. Now, so far, declines in credit quality haven't translated into significant loan losses, at least not yet. So what we have plotted here is the net charge-off rate for C&I loans. And this time series is actually 1 quarter behind. It's only going through 2Q20, but we can still get a sense for the overall slope and direction of the trend. We can see here is that C&I charge-offs increased in 1Q20 and then again in the second quarter. Now, some banks have been very aggressive this cycle in recognizing early losses, hoping to shed risky loans before problems accumulate later on. For other banks, the liberal use of payment deferral options have given borrowers a critical lifeline and delayed a spike in charge-offs until what they're projecting till at least 2021. In fact, in the last couple of months, we actually conducted a number of surveys about commercial loan deferrals. I know we've been making a lot of mention of that throughout this webinar. And what we learned from these surveys is that about 60% of the banks reported that fewer than a quarter of the borrowers that received a deferral will get a second one. So again, the majority of banks are saying that of all the banks they gave a deferral to, less than a quarter of them will apply for a second one. So these next few months will be very critical to see if borrowers in distressed industries like hotels and leisure can resume regular payments and avoid defaulting in large numbers. So with higher charge-offs potentially looming on the horizon, a lot more attention now is turning to structural trends and the strength of the collateral securing commercial loans. Thankfully, the vast majority of commercial loan volume, commercial new renewed volume that is in fact secured. So if you look at the left-hand chart, the trend series we have there, we can see that as of the third quarter, unsecured loans made up just over 20% of the total volume, which is actually the lowest ratio reported in several years. We've actually can go back even further in time, and I think this 20% is one of the lowest statistics we've seen in quite some time. Note that this ratio does include both bilateral loans and syndications. We tend to see a higher unsecured incidence for the syndicated deals. For bilateral loans, I believe the unsecured incidence is actually much lower than what you see here. So given that we're in the midst of an official economic recession, I think it's safe to say that collateral remains largely non-negotiable in most cases for the issuance of new credit. Then when we split it by deal size ranges, which you can see on the right-hand chart, we see a surprisingly high degree of uniformity across the deal size ranges. So uh, the right-hand chart shows that consistent across all the deal sizes, at least 3/4 of all the new renewed volume in 3Q20 was secured by some collateral type. The most popular one being secured by non-real estate. That could be a variety of different collateral types. Then of course you have secured real estate also comprising a big share of the total for many of these deal size ranges. So when we look at pricing in the context of credit risk, we are seeing other signs of tightening in the commercial lending space. The left-hand chart on this slide provides spreads on floating rate loans, so loans tied to LIBOR prime, where the blue series is investment grade floating loans and the red series is non-investment grade floating loans. Year over year, spreads were up in 3Q for both segments. The increase, though, was larger for the non-investment grade loans. It was a marginal increase for investment grade, a more pronounced increase for that red series at the top, the non-investment grade loans. But I think the question here is, given the fragile state of the economy, are the spread increases enough to compensate banks for the credit risk in their commercial portfolios? There's not an easy way to answer that question, although we can look at credit spreads in the bond market for a comparable risk premium. So one of our preferred market barometers of risk tolerance is the difference between the BBB corporate yield and the 10-year Treasury rate, where a higher spread between those two series indicates a lower tolerance for risk. The year-over-year increase in that credit spread was comparable to the increase that we saw in the floating rate spread for non-investment grade loans, the red series on this chart. So at the present moment, increases in loan spreads for non-investment grade loans are on par with the credit spread in the bond market, meaning that loan pricing is generally commensurate with credit risk. For fixed rate loans, which we have on the right-hand side of this page, yields are down year over year for both the investment grade and the non-investment grade loans. The decline, though, for the non-investment grade loans, the red series, was smaller than that seen for investment grade loans, meaning that even in a low rate environment, banks are making fewer pricing concessions for the riskier borrowers. One of the common themes we hear from all the banks we work with is just how widely pricing varies by geography. So Don had a great slide a few minutes ago where he looked at the loan growth by states, and you saw just how much that can vary state to state. We certainly see pricing as well vary substantially geographically. Even when you drill into the same state or look at a particular state, the pricing variances market by market, city by city, vary dramatically. So competitive conditions are certainly unique to each local market, meaning that banks can rarely obtain the same yield or maintain the same asset quality for that matter across different locations. That's why when we onboard a bank to the pricing dashboard, we provide them with the ability to drill down to the city level. So we have an example of that granularity here for California, in which we display the weighted average interest rate and the weighted average risk rating for the three largest core-based statistical areas in this state. We see a pretty interesting comparison here between Los Angeles in the bottom and then San Francisco in the middle of that side map. Between these two areas, we can see that pricing is better and pricing is lower rather, and risk is worse for Los Angeles. So you can really see just how widely even the risk and return fundamentals can vary city by city within a particular state. The key point here is that depending on your bank's geographic footprint, your bank may have to make certain risk-reward trade-offs to remain viable or competitive within certain markets. Like geography, there are also clear idiosyncrasies when we look at risk-return metrics by industry. The scatter diagram on the left here plots the weighted average risk rating on the x-axis and the weighted average interest rate on the y. All the dots are the 20 largest NAICS subsectors in the database. Generally speaking, the industries with higher credit risk also display higher yields, although there are some outliers on this chart. In this matrix, we can see, for example, that compared to market averages, computer and electronics manufacturing bears lower risk, but also a lower weighted average interest rate. You can see that sector in the bottom left quadrant on that chart. Conversely, banks can earn a higher yield lending to, say, doctors and dentists in the upper right, if they're able to tolerate the higher credit risk of this subsector. Now, the picture here is a point in time snapshot, whereas the right-hand scatter plot, it shows these same metrics, but shows the year-over-year changes along the axes. So industries in the bottom right quadrant experience deeper erosion in pricing, as well as more pronounced deteriorations in credit risk. Interestingly, computer manufacturing, which we just highlighted a few minutes ago, falls within this unfavorable quadrant, meaning that it's trending in the wrong direction from a risk and return perspective. It's seeing a really deep decline in yield, and risk is rising at a higher level than the C&I average. We also see very different profiles between a couple of healthcare industries, namely nursing care facilities and doctors and dentists, which we've called out on this diagram. So you can see nursing care facilities in the bottom left quadrant, meaning a deep decline in pricing, but also improvement in risk, whereas doctors and dentists in the upper right, that sector is showing less erosion in yield, but also a more pronounced increase in credit risk. So it just goes to show you that even within the same broad industry like healthcare, two subsectors can bear very unique risk and pricing drivers. Now, one question we received a lot recently is which sectors have been impacted the most by the pandemic in terms of credit quality? As we mentioned, industry risk return profiles are diverse and unique. That being said, there are some subsectors that have endured what you might call the first order effects of the recession. So hotels is a sector that comes to mind. When states issued travel restrictions and stay-at-home orders at the start of the pandemic, revenue at hotels took an immediate hit. Several banks have actually dedicated entire sections of their earnings presentations to what they call high impact or COVID sensitive industries. So what we've done is we've combed through these presentations and identified the sectors that the banks tended to have in common. We have the trend in non-performing loans, meaning loans that are delinquent or non-accruing for the whole group of high impact industries on the left-hand side. And then we have those same figures for the individual subsectors that comprise the high impact grouping on the right-hand picture. What's interesting is that even before the pandemic, the non-accrual rate for the high impact group far exceeded the average for the rest of the commercial loan market. Additionally, over the last 6 months, we've seen delinquencies and non-accruals rise at a faster pace for the high impact group. Now, a major driver of this trend is the oil and gas sector, which is one of the high impact industries that we have listed here. So if you turn your attention to the right-hand picture, you can see the exceptionally high non-accrual rate for oil and gas, which is third from the right on that particular diagram. But other industries are contributing to the group's overall troubling performance as well. For instance, hotels and restaurants and bars both exhibit much higher levels of problem loans than the market average. One of the economic terms that we've been hearing recently is a K-shaped recovery. I know we've heard a lot about V-shaped recoveries, but a K-shaped recovery refers to the divergence in trends for the high impact group versus the rest of the market. So industries that were able to adjust to stay-at-home protocols and social distancing will recover much faster than sectors like hotels and restaurants, which are going in the opposite direction. Over time, and looking ahead over the next few months, we expect the risk and return trends of these two groups, the high impact group and the rest of the C&I market, to diverge even further. So by all indications, the third quarter was a challenging quarter for commercial banks, although we at least have some encouraging news regarding the broader economy. In terms of loan growth, commercial loan balances continued to fall this quarter as many borrowers that drew down on lines of credit in March and April repaid their balances. A rebound in commercial loan growth may very well depend upon a second round of government stimulus or more clarity around the timing of an eventual COVID vaccine. While interest rates charged on new renewed commercial loans remain low, we did see spreads widen year over year, both for investment grade loans as well as the non-investment grade borrowers. Pricing for risk will continue to take center stage in portfolio management discussions, especially considering the rise in problem loans for the high risk industries. So as always, we really appreciate you taking out the time today to attend this webinar. We know it's been a challenging quarter for us all. It's been a very interesting week as well, to say the least. So we really appreciate all your time. Rest assured that AFS and our BI team is always here to help you navigate these market forces and what they may mean for your portfolio. So Renee, with that, I think we'll take a moment to see if we had any questions come through through the chat area.
Sure, Jeremy. We actually did have one question that came in while the others are assembling. And the question is, are you hearing any banks adjusting their risk appetite statements during this economic downturn? Example, tightening, further quantification, et cetera.
Yeah, that's a great question, Renee. We're definitely hearing, at least anecdotally, that banks are becoming more conservative in their underwriting standards. I don't know if they've gone so far as to adjust the risk appetite statements. One thing we're seeing for some of the riskier sectors, our banks are actually developing unique risk ratings for the COVID-sensitive industries, where any industry or any borrower in an industry deemed high risk, like hotels or restaurants, is given a temporary rating until more clarity is available around the outlook for credit in that sector. So I don't know if risk appetite statements have been changed, if that's been formally done just yet, but we're definitely hearing that banks are becoming more conservative and really scrutinizing the quality of the higher risk industries.
Thanks, Jeremy. It doesn't look like we have any additional questions at this time. So we would like to thank you for participating in our webinar today. And as is stated here on the slide, we will be sending out a link for you to download and or listen to this webinar tomorrow. So thank you all and have a great rest of your week.
Thank you, Renee.
Thank you.
Thank you all.